how to pass a funded account in 2026. Let me be honest with you right from the start. In 2026, passing a funded account is not hard because trading is difficult. It's hard because most traders are doing the exact opposite of what these challenges are designed to reward. Funded accounts are not created to find the most aggressive traders. They are created to filter out undisciplined behavior. And if you treat a funded challenge like a lottery ticket, you will fail again. In this video, I'm going to show you exactly how funded accounts are passed in 2026, what has changed compared to previous years, and the mindset and execution framework you need if you want consistent payouts, not just a lucky pass. No hype, no shortcuts, just reality. Why do most traders fail funded accounts? Over 90% of traders fail funded challenges not because their strategy doesn't work, but because their behavior doesn't. Most traders risk too much early, trade too often, and always keep new challenges running because funded trading is no longer about luck. It's about structure. Consistency is watched closely. Explosive one-day passes are now red flags. Slow, controlled equity curves are preferred. Automation is taking over. A large percentage of past accounts in 2026 come from rule-based systems, algo-assisted execution, and semi-automation. Manual emotional trading is being filtered out. Before we talk about execution, we need to address something critical. Not all prop firms are realistic to pass. In 2026, choosing the wrong prop firm can make a profitable trader fail, even with a solid strategy. The prop firms I recommend focusing on are the 5%ers, Alpha Capital, FTMO, Funded Next, and Funding Pips. These firms are designed to evaluate risk management, not to quietly eliminate traders through hidden constraints. Many cheap prop firms advertise low challenge fees, large account sizes, and big profit splits. At first glance, they look extremely attractive. But this is where most traders get trapped. These firms often introduce strict consistency rules, limits on how much profit one day can generate, and implied requirements for extremely high win rates. On paper, this sounds fair. In reality, it makes passing statistically unrealistic. A common rule says that no more than 20 or 30% of total profits may come from one day. Sounds reasonable, until you understand how markets actually work. Markets are not evenly distributed. Some weeks, one day does most of the work. Consistency rules force traders to reduce winners, take unnecessary trades, and avoid high-quality setups. This doesn't improve discipline. It destroys expectancy. Some firms don't explicitly demand a high win rate, but their rules make it unavoidable. If you can't let one trade make meaningful profit, can't have losing streaks, and must grow the account evenly every day, you are forced into small targets, tight stops, and frequent trades. A professional system does not need a high win rate. It needs controlled risk and positive expectancy. Here's the irony. The well-known prop firms often have higher challenge fees, but they are easier to pass long-term. Their rules align with real trading behavior. Uneven profit distribution is allowed. Risk control is rewarded. They evaluate how you trade, not how well you game their system. Now let's talk about the real goal of a funded account. The real goal of a funded account is not to pass it. The real goal is to extract profits from it, month after month. A funded account is temporary by nature. You can lose it because rules change, firms shut down, programs disappear, or you violate a rule unintentionally. That's why you should never emotionally attach yourself to a funded account. Once you pass, your only job is to trade conservatively, withdraw consistently, and treat the account as replaceable. Professional traders always extract profits and keep starting new challenges at other firms. Pass, extract, replace, repeat. That's how funded trading becomes a business. Now let's talk about execution. There are 4 legitimate ways to pass a prop firm in 2026. Some are conservative, some are aggressive. All of them are based on statistics, not hope. Way 1 is the correct but longer way. You start by looking at your backtest, specifically your compounded annual growth rate and your maximum drawdown. Most prop firms use either a 2-step or 1-step challenge. 2-step challenges usually require a 10% target in phase 1, with a 5% daily loss limit and a 10% max loss. Phase 2 requires a 5% target with the same drawdown rules. 1-step challenges usually require a 10% target, a 3% daily loss limit, and a 10% max loss. If your strategy has a CAGR of 30% and a max drawdown of 15%, cutting your risk in half reduces your CAGR to roughly 15% and your max drawdown to about 7.5%. That fits comfortably inside prop firm rules. Statistically, you will pass. It will just take longer. This is the safest and most professional approach. Way 2 is using strategy seasonality. Every trading strategy has seasonality. Some perform better in certain months or volatility regimes. If your backtest clearly shows this, you can start challenges during strong periods and slightly increase risk. You're not forcing trades, you're timing probability. Way 3 is starting after a losing period. A properly backtested strategy shows its maximum losing streak. If that streak is 10 trades and you are currently on trade 8 or 9 of a losing run, statistically, you are closer to the next winning cycle. Starting a challenge here can reduce time to pass while keeping risk normal. This only works with robust, well-tested strategies. Way 4 is the riskier dual account method. You buy 2 accounts. One account trades the strategy normally, the other trades the inverse using social trading tools. If the strategy is hot, the normal account passes. If the strategy is cold, the inverse account wins. This works best with 1-step challenges. 1-step probability is roughly 50%. 2-step probability is 50% times 50%, which is 25%. That means 1 out of 4 attempts succeeds on average, assuming a solid strategy. This method is capital intensive, but purely statistical. Now let's talk about why rule-based and algo trading dominates in 2026. Rules remove emotion. Even simple automation like fixed risk, automatic stops, and predefined exits already puts you ahead of most manual traders. The future of funded trading is discipline through systems, not willpower. A real passing day looks like this. 1 planned session, 1 or 2 trades, no revenge trading, stop when the rules say stop. No excitement, no stress, no dopamine. If your heart rate spikes, you're risking too much. Passing a funded account is a discipline test. Extracting profits consistently is the real win. The traders who succeed in 2026 are not smarter. They are calmer, more systematic, less emotional. They don't protect accounts forever. They extract value and move on. If you want to succeed with funded accounts in 2026, reduce risk, trade less, choose the right prop firms, withdraw consistently, and always keep new challenges running. Because funded trading is no longer about luck. It's about structure.